Welcome to TradeTheMBI.com. This is Jonas Report. It's for the 24th of June, back from my lake holiday. A little bit of sun. Didn't miss a whole lot. We had the big option expiration, but as you can see, it wasn't a whole lot of anything. Yes, a little bit of softness, and that's represented here in the magenta dipping below yellow back on Thursday, and then Friday obviously it continued down below 33 potentially for today. That means if we come back down towards that ABM yellow, yeah, you're likely to break below it, but without a significant increase in short interest, not really that much, and certainly not white MBI down here, because until that pops up above 8 7, 8 range, you're really not going to get a whole lot of anything. It is corresponding to with the DOC spread, which cyan above red for the first time, so expressing some softness. But at the end of the day, the market is pretty content with where things are at. Fed isn't going to do anything, and they've been rather benign in their treatment of everything market related. From an NQ standpoint, you can see there's just a little bit stronger of that breakdown, but what that's providing is without much movement, you're getting a significant reset of your reading. So it's basically a softening, a little bit stronger from its MBI white reading, but not collectively much, and just about to get there at that 452 to 470 from a DOC. So that means red's still leading. Science is a little bit different, but you can see that the S&P and the ES starting to catch up. Almost. It's close. It's not quite there. Overall, though, I think that we're just seeing more of the same. This excitement of being in the market. From a tech standpoint, AI, that whole trade is just moving exponentially. Is it far beyond? It just does remind me a lot of 2000, when you had everyone jumping into internet mobility and potential expansion, and that was way early. It got way excessive, and you ended up with some real serious failures, WorldCom and some of these other ones that happened during that time. And so it was quite an interesting period. When we move to the Treasury market, it's a disaster. At the end of the day, I mean, when you're seeing numbers like these, you're just wondering, it's like, based on this, the Fed should be cutting to zero tomorrow. And we know that isn't happening, because we've all seen what's been happening with oil. You have continued attacks on Russia's oil infrastructure, which have caused some significant situations. And I think that's only going to be problematic, because as you see energy rise, you're just going to follow back in inflation. So what are they going to do? Pretend that there's no inflation and still offer yields that are substantially negative? Who's buying that? It's shocking in so many different levels. I don't think anyone knows really what they're up to. And is that unusual? It's happened before. We've been seeing it for the last year plus, irregularities in the bond market and its activity. I don't know why my charts are not moving as quickly as I want them to right here. Oil, you can see here it is, skyrocketed. And you're back now above the same levels where the CPI was growing. So it's worth noting. And, how long can the delusion last? Well, quite a while, actually. You'd be surprised that we've seen plenty of dysfunctionality in markets that take a while to resolve themselves. But when they do, it will be significant. So it's just a matter of waiting for the signals that will indicate that it will do it. Now, we understand reality, and so we're just waiting for the convergence, or at least the trigger point where reality becomes more known, and it becomes the consensus, as opposed to this avoidance, which is what we're in right now. And from a euro standpoint, it's just fantastic that euro's been able to even hold up above parity, because they're in a world of hurt now as oil continues to rise. Obviously, you have the political tensions have mounted with immigration and everything else, and it's going to be substantially more difficult for them to move towards their green energy ideals that have been decimating the economies throughout Europe. And the rebellion from regular people who are just fed up with the regulations and that don't seem to be providing any value whatsoever in their lives. And when we get to crypto, been pretty well sedated. Here we have gold as being held pretty reasonable level because, of course, we had that slowdown in what inflation was, and this expectation is that there's not even going to be zero inflation. It's going to be starting to move towards negative. That ain't happening, so I wouldn't be all that concerned. Just it provides a discount. What we have seen is a flee from crypto because why would you be in crypto when you can be in the market getting just as much of a return? So when things turn to fear, this will be the hedge. And this could exacerbate itself some more because with the halving that took place, you have miners who typically are either going to have to go offline or cash in what they've got in order to sustain the fact that they're running upside down relative to what the return is from the machines operating electricity wise and that setup. So it becomes an interesting dynamic. We're seeing the exact same thing. ETH not as bad. It had the nice boost coming back up from the regulation situation being eased, but still under the same pressure. And so when you see gold flip around, then you're going to see the same thing with cryptos. It's just not at this particular stage. When we look at it from 50K, pretty strong. I mean, these were the positive extremes we had from back on the 17. Mark the bottom one right here. That was at the 5506 range. Didn't quite meet it even within that selling. I filled in the others, which is healthy. But that just shows the strength of the situation at this particular stage that you really fully met that one. You just came into the secondary one, about 80% of it going in right through there. So that just shows you how resilient things are. And it wasn't a whole lot of movement, particularly for option Friday. Kept it pretty stable, and everyone was pretty comfortable with their positioning. So that's what you get. It's not unless there's a surprise of some kind that you get dramatic swing, or where you have people so imbalanced that they have to do radical things in order to be okay. Intraday, from a 5K standpoint, even getting tired of the 5 minute here, yeah, you had a few little swings up and down, but generally rather soft. I wouldn't call it dramatic in any way, shape, or form. I know it was a lot of hype. And whenever I see there's hype about an option expiration, I'm just like, okay, it's going to be a dud. It just gets people excited. So already we've had our pre-market dip, try and clear out any weekends, and then just bring it right back to the exact same spot. So that's the long and the short of it. It's going to start to get exciting though as the election starts to heat up. We've got debates that any major faux pas could cause some ripples, but certainly the economic data is going to continue to drive things. And as long as nothing is falling off a cliff, it's going to be pretty much the same thing. As always, though, anything relevant, I'll put on the Skype chat for you. Have a good one. Trade one.